Welcome to my presentation. My topic is money market instruments. Money market, as the name suggests, are tools which can help one operate in the money market. Some of the major money market instruments include bankers' acceptance, treasury bills, repurchase agreements, certificate of deposits, and commercial papers. They are short term financing instruments to increase the financial liquidity of business. The money market refers to trading in very short term debt instruments. At the wholesale level, it involves large volume trades between institutions and traders. The money market involves purchase and sale of large volume of short-term debt products such as overnight reverses or commercial paper. An individual may invest in the money market by purchasing a money market mutual fund, buying a treasury bill, or opening a money market account at a bank. The very first money market instrument is Certificate of Deposits or CD. A CD is defined as an investment instrument mostly issued by banks, requiring investors to lock in funds for a fixed term to earn premium rates. Most certificate of deposits are not strictly money market funds because they are sold with terms of up to 10 years. However, CDs with term as short as 3 months to 6 months are available. Unlike a money market account, the rates offered with a CD remain constant for the deposit period. Next is commercial paper. Commercial paper is a short term debt instrument issued by companies to raise funds generally for a time period up to 1 year. They are typically issued by large banks and corporations to cover short term receivable and meet short term financial obligations such as funding for a new project. Next one is banker's acceptance. The banker's acceptance is a short term loan that is guaranteed by a bank. Used extensively in foreign trade, a banker's acceptance is a post-dated check and serves as a guarantee that an importer can pay for the goods. There is a secondary market for buying and selling banker's acceptance at a discount. The banker's acceptance is a form of payment that is guaranteed by a bank rather than an individual account holder. Next is euro dollars. Euro dollars are dollar dominated deposits held in foreign banks and are thus not subject to Federal Reserve regulations. Very large deposits of euro dollars are held in the banks in the Cayman Islands of the Bahamas. Money market funds, foreign banks, and large corporations invest in them because they pay a slightly higher interest rate than the US government debt. Next is repo or repurchase agreement. Repo is a form of short term borrowing for dealers in a government security. In case of a repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day at a slightly high price. That small difference in price is the implicit overnight interest. Repos are typically used to raise short term capital. They are also a common tool for the central bank open market operations. The last money market instrument is treasury bills. Treasury bills, also known as T bills, are short term money market instruments. The RBI, on behalf of the government, to curb liquidity shortfalls. It is a promissory note with a guarantee of payment at a later date. The funds collected are usually used for short term requirements of the government. It is also used to reduce the overall fiscal deficit of the country. Treasury bills or T bills have zero coupon rates. That is, no interest is earned on them. Individuals can purchase T bills at a discount to the face or value. So these are the major money market instruments, and thank you.